Sensei Kujaku.
After graduating from IIM Ahmedabad, Manish Gupta spent 15 years working at consulting firm Boston Consulting Group and investment firm Rare Enterprises, where he worked with legendary investor Rakesh Jhunjhunwala. Manish then set up his own fund, Solidarity Investment Managers, of which he is the CIO. From a standing start in 2014, Manish and the team have built Solidarity into one of the preeminent PMS funds in India, with an AUM of close to 1,500 crores across 300 client portfolios. I sat down with Manish at his office in Mumbai to learn more about his investment framework, spotting trends early, and lessons from a former boss. Manish, I want to start with what led you to where you are today. Could you talk about your motivation for starting your own firm and your own fund at a time when you were working with one of the world's greatest investors?
Yeah, so I worked with Rakesh Bhaiya for 8 years. I learned a lot, but I was 41. I just, the primary motivation was to build something, build a company, and this was, we have come from middle class backgrounds. Asset management is a good company to attempt to build because it doesn't require a lot of capital. So the primary motivation was to build something, and then I also wanted more creative freedom and control over my time. So this was a very good opportunity in order to be able to do lots of that. So Rakesh Bhaiya was obviously very supportive because he understood, he himself in some sense was an entrepreneur. So he respected my entrepreneurial aspirations. So yeah.
And what are some of the key lessons you learned at your time at Rare, be it directly or just from observing Rakesh Jhunjhunwala? And also along with Rakesh Jhunjhunwala, there were also very accomplished investors beyond him at the firm.
Yeah, I think it's a great question. There's so many things I learned from him. But there's so many things, I don't know where to start. I guess if I just restrict the answer to the investing domain, I think it would be that compounding works, right? If you look at most of the wealth that he created, a lot of it would be concentrated in a few companies that he bought in, and he just let those companies ride over long periods of time, right? So the power of compounding, the power of staying invested, the power of taking long-term calls on companies is something that I think is a very powerful lesson that I've learned from him. And I think that just to keep the process very, very simple, right? I mean, essentially at Rare, we answered three simple questions. That, do I believe in the market opportunity? Do I believe in the promoter? And I'm paying a broadly fair price, right? There wasn't too much of analysis and paralysis. And I think probably the third lesson that I would highlight, and something that I'm using when we are building our firm, is to take responsibility. The buck stops with me, right? You can't blame the environment, you can't blame an analyst for a certain recommendation. The responsibility lies with you. So I guess there's a lot I could talk about, but just from an investing perspective, I guess these are at the top of my mind, some of the things that I think I would attribute to what I learned from him.
And today, given that you handle capital that is not just yours, but you're handling external capital, do you sometimes find it very difficult to stay the course in an investment where you feel that you just need to give it more time for your thesis to play out, but there's always pressure of performance?
Krish, that's a great question, and I think that's the biggest challenge in fund management. I mean, typically you will see funds getting marketed as 1 month performance, 3 month performance, 6 months, 1 year. So that's a big challenge, and I think it requires us as fund managers to be very honest with ourselves on what game we are playing. There's a great quote that the biggest challenge in life today is not playing the game, but it's to have clarity on what game you're playing. So are you playing a T20 game? Are you playing a 50 over game? Are you playing a test match? It's not just about playing cricket. It's what game are you playing? So, we are very clear that we are optimizing for long-term outcomes, right? And yes, sometimes it creates an issue where some clients would have us a bit more short-term oriented, but we don't think like that. And I think we are very clear that this is the way that we will think. We will provide a lot of transparency in how we are thinking. We will be very honest about our mistakes, but we are not going to change our path from thinking ruthlessly long term. Now, we also believe that the way to the long term is through the medium term, right? And I can't expect our clients to stay with conviction with us over a decade if we are not performing short term. So what we tell clients upfront is that the way we will measure our progress is what returns are we doing on a rolling 5-year basis. So 5 years, I think, is a good compromise between the medium term and the long term. And typically I've seen that most of the families we work with are very happy with that kind of time horizon in which to act and to take decisions. And we don't lock in capital, we don't have any exit loads. So there could be people who realize that the time horizons in which we think are probably too long term for them. In which case, we would never hold their capital back and we would try and give. But that's been very, very rare for us. So we've been lucky that we've had very, very sticky money for a long period of time.
So Manish, let's now move to the investing framework that you use at Solidarity. Could you talk about some of the 2 or 3 central tenets that you use to analyze businesses and decide which companies to invest in and which companies to avoid?
Okay, so 90% of our portfolio is in what we call secular compounding companies. So we are essentially, we want to hold companies for long periods of time because we want compounding of earnings to work. So essentially the principal question we are asking is that, is this a company where we think that over the next decade earnings can grow between 15 to 20%? And is this a management team that we can trust? Does this company generate ideally over a 20% return on capital, but at least a 15% return on capital? And can we trust this management team to act with discipline both in how they're building the business and how they will look after minority shareholder interests? So these are some of the broad questions we're answering. So before we come to the question of what is a fair price for this company, the 2 more important questions we're trying to answer is that do we see conditions which will allow compounding of earnings? So essentially you're looking for industries which have secular growth prospects. So for example, I think manufacturing out of India, I think is a theme that should have secular prospects because you've got some great companies in India that were already doing well, but now you've got the additional tailwinds of the world trying to de-risk from China. And certain sectors, for example, chemicals, India is quite advantaged. Chemicals requires an ecosystem. You just can't start manufacturing chemicals in, say, Vietnam or Bangladesh. It requires an ecosystem. Banking, as India does well, there will be demand for credit and the strong banks are getting stronger. So essentially you're trying to identify secular themes. And then within those secular themes, we are huge believers in buying into leaders because we think that leaders, if you just look at history over time, you see in every sector the stronger players are getting even stronger. So if we are looking for secular themes to ride over long periods of time, then we are looking for a sector that provides the opportunity for secular growth. We are looking for companies who are leaders in those sectors. And essentially what we are looking for is a broadly fair price that we want to pay for those companies. That's it. It's a very simple process.
So an important component within your framework is this concept of right to win that you often talk about. Mm-hmm. Could you explain what that is? What specifically you look for in companies to determine whether they actually have the right to win? And it would be great if you could talk about right to win in the context of a banking company and specifically the lending business within banking.
Okay, great. So, there could be a completely new industry where different players are taking positions, right? So a right to win is never clear in a new industry that is just being formed because different players are taking positions in that industry and still building competencies. But you have certain industries which are fairly evolved, for example, banking. where it is very clear who is the best positioned in that particular industry, and the person who's best positioned, unless they screw up, are actually positioned to win and keep getting stronger, right? So, I mean, let's take this concept from the perspective of banking. Banking is actually quite a simple business that you take deposits from the public. You earn a spread on this when you give them out as credit, and you'll have some loans that go bad, and you have some costs. So it's a very simple formula to make money, which is you try and borrow as low as possible. You try and lend in a way that you will lend to segments where you will earn a decent spread, and your bad loans will not be so bad that all your spread gets eaten up by bad assets, and you keep your cost low. It's a very simple formula. Now, the player who will be best positioned to win in this business will clearly be the ones who has the lowest cost at which they raise their deposits, because if you have the lowest cost, you are the best positioned to choose which segment do you want to lend to. You don't have to lend to the riskiest segments to earn a high spread. If you are raising deposits at a low enough cost, you can actually lend to the safest segment, earn a decent spread, and because you're lending to safe segments, your bad performing loans are going to be low. And so without taking extraordinary risk, you can continue to earn a decent spread and a decent profit. Now, you could be a bank or a new entrant who does not have the lowest cost of deposits, right? Now, very clearly, if you don't have the lowest cost of deposits, you will have to seek customer segments which are higher risk, because how will you earn a decent spread otherwise? If, for example, somebody's got a cost of funds, say, of 5% and is giving a home loan out at, say, 8%, they're making a 3% spread. But if someone's cost of funds are 6% and they give the same home loan out at 8%, they're not going to make any money at just a 2% spread. They have to find riskier segments whom to lend to. So now you could be very smart and you could find those segments, but the problem is then that has a problem of growth. Because if you also want growth, you need to keep finding such customers where you believe the market is mispricing the risk. And what history has shown us, that this typically does not end well, right? If you look at the history of banking in India, other than HDFC, Kotak and Bajaj Finance, which together might be less than 15% market share of the system, everyone's blown up if they try to take too much of risk, right? So the concept, again, from our perspective of right to win is find what drives value in the industry. In this case, it's lowest cost of deposits, a fundamental culture of conservativeness, and bet on people who are the best positioned on that, right? Obviously, you keep looking for some new names that might emerge, but the basic concept is that the winners tend to keep on winning. So find out who's won, why have they won, is there a pattern there, and just continue to bet on those leaders rather than someone who's coming in new and growing very fast and believes they've cracked the code. That's always a short-term play. History tells us that is not ended well in banking.
So in that case, in the lending business, in order to invest, is it necessary to extrapolate past performance?
So, Krish, I'm not saying there's only one way to invest, right? I'm saying there's a certain thing that we are trying to do for our clients, our partners, as we call them, which is to say that the index tends to compound at anything between 11 to 12%, right? We don't want to take extraordinary risk, and we believe that as we are active managers, we need to create a little bit of alpha over the index. So I'll be happy if over very long periods of time I can compound capital for clients between 15 to 18 with prudent risk taking. Now, this line of prudent risk taking is very, very important, right? Now, a banking entity is typically leveraged 10:1. When you are leveraged 10:1, there is very, very low margin for error, right? So, in our construct, now somebody might look at this differently, and I have no quarrel with that. In our construct, if I can invest into a well-run bank and I see a roadmap to making 15 to 18% return without excessive risk taking, because I understand what's going on, I will not get tempted to invest in a lender who does not have that right to win, who's pursuing riskier segments, but who might be growing faster and theoretically could make maybe a higher return, right? Because every investment outcome is actually a thesis multiplied by a probability, right? So the more you go into segments which are not pristine credit, your probability of going wrong increases because they are more vulnerable to any external environment, to any change or any vulnerability to any stress in the external environment. So when one is leveraged 10 is to 1, I don't want to go down that path, right? So I prefer companies who are so positioned on the deposit side that they can just deal with the top 3-5% of the pyramid and still grow, right? Now, they might, like I said, there might be some people who believe they have the expertise to find out gems who are operating in a different part of the pyramid and can grow faster. We would rather take those risks in industries where the leverage is not 10 is to 1. So I would prefer taking that risk in small caps, in manufacturing, or in other themes, but not in banking. Now, that's just the way we are wired. Someone else might think very differently, and like I said, I have no quarrel with that. I would have no argument with somebody who wants to take risk in microfinance because he sees a mispricing or something. It's just not something that we want to allocate capital to.
Right. So it seems that one of the most important things when investing in a lending company, really more than looking for growth, is to make sure you're investing in someone who's not going to blow up. And an important part of that is assessing the quality of the loan book of that lender. So how do you go about assessing the quality of the loan book of a lender looking outside in? And often what we see is that people rely on historical numbers. But ultimately, while they are important, they are a reflection of past decisions, either good or bad. But how do you evaluate decisions that are being made today, given that any mistakes that are made will only be realized 2, 3, 4 years down the line?
Yeah. I think it's a great question, Krish. My ex-boss would always say that, make investing an act of wisdom, not one of intelligence, right? Now, banks are notoriously opaque. There is no way one can assess the granularity of a bank's book because that granular data is just not present. So your only defense when you're investing in a lender, really, other than the low-cost deposit base at which they've started, really, is the credibility of the management team. That can you trust what they say, or do you have? If you cannot trust the leadership of the bank that you are investing in, right? I would not go down there, right? So there is no way as an analyst sitting outside the bank I can evaluate the granularity or the risk in a bank's loan book or how the risk has been priced. There's just no way I can do it. So my only defense is what is the culture, what is the outlook, what is the thought process of the leader, what is the longevity of the team around him. So is that a bit more institutionalized culture? What has been their track record of provision? So for example, if you look at Kotak Bank, Uday Kotak has always taken provisions up front, right? If you look at some of the other banks that have gone belly up, people would always wonder how is this bank reporting such low provisions despite not having the lowest cost of deposits, right? So we would not attempt to, even go down that path of trying to size up a bank's loan book and trying to address that from the outside. Because even if it was possible, you could do it on a spot basis, right? But to try and do this, every quarter, you are essentially double guessing a bank's management decision, right? Now, that's not the way we want to invest. We want to invest on a broad opportunity. We want to bet on a management team. Now, if I'm having to try and go through a bank's books, then I'm not investing on the bank's management team. I'm trying to doubt what they are doing. I just don't think that's a very pleasant or low stress way of investing.
So let's actually talk about culture in the context of the lending business. How do you assess the culture of a bank, and what role do you think the CEO or upper management more generally plays in not only developing the culture but actually maintaining the culture over a long period of time?
So, culture is a big word. I would say very simply, don't focus on what people say, just focus on what they do. So you should just look at the track record of how a bank is operated. So, for example, when HDFC was formed, they spent a lot of time. In fact, the entire book was low duration credit, very working capital loans. If you look at HDFC, they dodged all the infrastructure bullets in 2008. If you look at the way they provision, right? I'm saying you just have to look at what people are doing, right? You don't need platitudes around we are very conscious of risk. Everyone will say that, right? But it's not about what you say. Is it what have you actually done, right? I just mentioned, I said, look at the longevity of the team. If a team has been around for long periods of time, you can be sure that the culture or the fundamental approach to risk that has been set in place by the CEO, if the team has hung around for a long period of time, that there's a higher probability that would have been deeply institutionalized. Right? So again, if you look at banks that have gone belly up, they didn't have teams that were working together for long periods of time. If you look at the leadership they had, it was a bit more quote unquote brash, trying to grow too fast. Right? Any bank, I think, that is trying to grow too fast, I think that's a red flag, right? Because I think there's a trinity in banking, the way we think, that you cannot have high growth, good ROEs and low NPAs. I just don't think that's possible, right? Because the moment you're growing too fast, you have to compromise a little bit on the number of customers you can find who are good enough for that credit, right? So any bank that is trying to grow excessively fast because they believe that they have identified pockets that others have not seen, I think it's a huge red flag, right? And again, in our context, is that we are here to take prudent risks, right? But when you are investing in an entity that is leveraged 10:1, your margin of error is very, very small. So when I'm investing in an entity that is 10:1, I would prefer not taking that risk. And I would prefer taking that risk in more names like manufacturing, where the debt to equity is far lower, where even if you make some errors, because your leverage is low, you have the opportunity to correct those errors. In banking, when you have that leverage, errors just compound, right? So that's not a path we want to go down.
A major theme in investing in banks in recent times has been this idea that the NPA cycle has bottomed and a new credit cycle is beginning. While that may be a consensus opinion today, I remember a time some years ago when it seemed like there was no light at the end of the NPA tunnel. You, however, were a believer in this trend some time ago, and you actually put your money where your mouth is and your clients' money where your mouth is and invested in some of these companies. Could you talk about what gave you the confidence to invest at that time when it seemed like things could only go from bad to worse?
Okay, so this example that I'm taking, I think, Krish, is very contrary to everything we spoke about. Now, I think we're talking about a particular bank, and I mentioned that 90% of what we do is actually secular trends, well-run companies. We keep about a 10% allocation in our portfolio for what we call special situations. Or we say, this doesn't seem like the best-run company, but the market is really mispricing it. So I think the opportunity that you're talking about was we felt there was a fundamental mispricing, and I think at that point in time there was a report out into the market which was listing because the RBI had done the AQR. There was a report out in the public domain which actually listed out banks and their exposures to different groups, and I think it was a one-off where a lot of data was in the public domain. So I think what we managed to do therefore was, for this particular bank, look at all its exposures, classify it into different sectors, and make some intelligent assessments. Okay, this is an EPC exposure. In EPC there is no collateral, so let's just mark this debt down to zero. Okay, this is a steel plant. So for a steel plant, at least the bank should get the depreciated value of the asset. So let's put that there. And this analysis led us to believe that the mispricing was enormous, right? And therefore we took a leap of faith and put some money in the portfolio there, right? Now this is again a very contrary example to how we would do it, but I was saying the pricing was absolutely extreme. Now this particular bank that we were talking about had a very, very strong deposit franchise. So our bet was that if the deposit franchise is very strong, and the bank was making all sorts of noises about pivoting into a more retail oriented franchise, far more granular lending, So we felt that there was a high probability that we would not lose capital because even if all the provisions needed to be taken, the bank would not need to raise external equity. Its equity base was still strong. It had a strong deposit franchise, and therefore its migration into a more conservative model could be a bet worth taking. So this is what we did, right? But there was a lot of mispricing that existed at that point in time. Would we attempt something like that again? You have to have a huge mispricing and a very strong deposit franchise for us to attempt that. We would not have done this if this particular bank did not have a very strong deposit franchise. So we would not do this for an institution, for example, like an NBFC. We would not do that, right? So this was an example, I think, of where, like I said, this was a special situation. It was not part of the core of how we invest.
So Manish, I'd like to now switch gears and talk about another sector that you mentioned earlier, which is the chemical industry in India. Before we get into some of the more micro factors, I want to talk about a broader theme that seems to be discussed ad nauseum these days, which is this China plus one and more recently the Europe plus one theme. What I want to understand is if you think it is necessary for these themes to play out for the development of the Indian chemical sector.
Krish, we've got some great Indian companies who, if we look at the time period, say 2003 to 2018, if you take that 15-year time period, I think you can see there'll be at least 5 or 6 companies that have actually grown top line, bottom lines by over 15%, right? Over 15 years, right? So these are good, strong franchises in their own right? Now I think China plus one or Europe plus one is an extra tailwind to growth, right? Now why has that happened? The world was very, very strongly reliant on China, and now for all factors everyone understands, people are suddenly saying that, resilience is more important than efficiency. We just cannot depend on 100% or 90% of our sourcing coming from one market, right? So we need to diversify. Now, the thing is that, when typically people are outsourcing manufacturing, it is typically because you're outsourcing from a cheaper location, right? Now, the advantage with chemicals in India is that chemicals needs an ecosystem. It's just not about labor arbitrage. Chemicals is a knowledge-based industry. When anyone is doing a product, over time, what smart companies do is that they increase the productivity of the asset. So the revenue per unit of capital invested, gross asset turns increases. Over time, smart companies discover better ways to make the same product, so you reduce the cost of manufacturing. So all of this requires an institutional knowledge. This is not knowledge that you can just replicate overnight, right? It's soft knowledge. In chemicals, it's just not about putting something in a pot and taking a product out. A lot of these processes are actually multiple steps. Now, take for example, a company we own in bromine chemistry. Typically, you will not have bromine, which is a part of the end product of a molecule. Bromine typically plays the role of a catalyst, right? And bromine is very corrosive. So, if you're using bromine in a process, you need to either recycle it, you need to either take it out and dispose it safely. Now, as a company who's doing this, it is in the company's interest, the end customer's interest, and in the company's interest to do more and more steps in one facility. So you reduce the overall cost of the end molecule that comes out. So this is a huge edge that India has. Now, other than China, other pockets of specialty chemical used to be Eastern Europe, other than India. But now, I think structurally, Europe will not get cheap gas from Europe, right? You will get gas from other sources, but the cost of that gas will increase because it's not going to come by a pipeline. So, therefore, India is a natural partner to many of these countries. So, what I'm saying is many companies were strong players in their own right, and now you're getting another engine strapped to help you boost growth. So I think this could be a decadal opportunity. Now, obviously, one has to look at the prices one is paying, but from a company perspective, I think this is a decadal opportunity that companies have in specialty chemicals and API in order to be able to grow.
So, If you look at the last year, I think a lot of people believe that the West takeaway from events that have happened in Russia and China and maybe some other places is that they have to diversify away from those countries into other countries for sourcing, for manufacturing, chemicals or otherwise. But is it possible that the ultimate takeaway will be that rather than moving to another country, they have to move manufacturing back home? And therefore, do you see the threat of de-globalization, and how do you reconcile that with the hope that India becomes a manufacturing hub for chemicals or even manufacturing more generally?
I think, Krish, there will be a lot of manufacturing that will go back because now, for example, TSMC has just broken ground on a plant for semiconductors, right? Many products are so strategically important that just from a geopolitical perspective, countries will start saying that, especially now because Russia used gas as a weapon against Europe, people will say this is so strategically important for me. I need to keep it in house. 95% of all antibiotics that APIs that go into antibiotics for the US are made in China. Now, that is a really scary position to be in if your biggest geopolitical rival is China, right? So, a lot of stuff will move. Now, in the pecking order, there's stuff that is more strategically important that should move first. And there is stuff which is not so strategically important. So, I'm sure some stuff will move. Secondly, I think, there is the theoretical argument and there is stuff that is practical, right? So, even if you want to move everything, we are now living in a global village. For every part, you've got a very complicated supply chain. So I don't know whether everything will move, right? And the third is that, as I was mentioning before, there's always a soft knowledge in how you do stuff, right? Now, this is not outsourcing of your supply chain for making clothes, where somebody is stitching a garment in India or Bangladesh, and now you say, I can take somebody in back of the boonies and they stitch a garment. In many industries, like I said, there is soft knowledge. In chemistry, you could have 3 steps, 10 steps, 15 steps. I just gave the example of how you got to dispose certain waste material. You need enough people who are chemists who have that knowledge. So it's not easy just to move everything back. It's going to take time. And while there is clearly a trend of moving some stuff back home, there is also a new term which they are calling, which is friend-shoring. That are there partners who are more aligned with the way we think in terms of geopolitics, and can we move more of our supply chain to them? So I think there will be opportunity. One has to segment the market in pockets where we think India will have an edge. So we are not very optimistic about textiles, but we are fairly optimistic about chemicals, about auto components, for example, where we think India will have a bigger role to play.
So let's now talk more about analyzing specific companies and the process that you use. What is your first port of call when studying a chemical company? Is it a deep dive into the underlying chemistry, or is there something else that you look at first?
So again, it's a fairly technical subject, and we like I said, we want to invest more on big picture, right? So if I go back to a framework, it is opportunity, the right to win, and a leadership team we can trust, right? Now, we want to identify companies that are exhibiting all that, and then let these companies ride. And you have a portfolio where you want to choose where you want to play. So typically what we do in chemicals again is that there are lots of good companies in India. So you want to be in pockets where we think companies will dominate niches. Now, there are lots of companies. How do you pick between them? So the way we've gone about it is we have investments in 2 sectors. We have investments in actually 3. We have investments in fluorine, we have investments in bromine, we have investments in fragrance fragrance and flavors. And the approach that we have taken is that there is opportunity everywhere. Why don't we find pockets where you have players who are fairly dominant, rather than find pockets which are intensely competed? So the probability is that when you have pockets which are more where people dominate niches, you will typically tend to see a better margin profile because people don't need to compete on costs, right? So we've essentially looked at growth. Now there's growth everywhere. So our hypothesis in fluorine was that the fluorine market should grow because the use of fluorine in both pharma and agro molecules is increasing. The industry structure in India is very favorable. There are essentially three players. Two players are dominant and there's a third player. And fluorine has fairly high entry barriers because it's a very reactive gas. You've got to, and as I've alluded before, that it's just not about setting something up. You've got to be able to do it more efficiently. So there's a learning curve. You need to have credibility with customers because customers cannot risk you experimenting on them. So our hypothesis was that if the use of fluorine is increasing, if India is going to have a better play, it's a three-player market. Whom do we want to bet on within this market? And we chose some companies based on the historical track record, our comfort with the promoters. We wanted a company that was looking at this opportunity and willing to go and invest more aggressively rather than wait for customers to come. So that was the thesis that we used. Now, ditto was the thesis that we used in bromine, one very dominant company. Essentially, it was that. We would not go down the path of trying to identify, for example, which API is going off patent and which company is better positioned in this API, because for the simple reason that we are not looking for something that will move in the short term. We're not looking for something that will do well in 2 or 3 years because there's an earnings spurt. We want companies that we want to hold for really long periods of time, in which case it becomes more of a macro call. You are betting on the management of the company to do the right calls. And we don't want to bet beyond a point on specific products. That's what the management will pick. You are betting that the management will take the right product call. The management will take the right capital allocation call. So it's really a more macro, high-level framework rather than using the analogy that you used of a bank, of trying to examine what is a bank's product profile or what is this particular company's product profile, right? The financials give you enough clues, right? A company which has a high gross margin has a richer product mix, a better product mix than a company that has lower gross margin. A company that is investing in capex and being able to fill up their plants clearly is getting a lot of business from customers. So one doesn't have to go into each product level detail to identify which company you want to bet on.
So if I could just pick up on the point you just mentioned, or for example, a company that has a high gross margin, but in the chemical business or manufacturing again more generally, are you always fearful that very attractive margins end up attracting incredible competition? If you take the example of fluorine, if you go back to when you invested, I mean, there were very few people who were even looking at that space, let alone investing. Today, everyone will expound on the virtues of fluorine chemistry and the moats and competitive advantages and long runway for growth. But when you are looking at this space, are you sort of always, do you always have to keep one eye open that, there's always someone trying to eat my lunch? Or is there something that gives you the confidence that even if competition enters, I'm not overly fearful because I believe that there is some specific advantage that the company that I've invested in will be able to fend off that competition?
It's a great question. See, Krish, every industry commoditizes over time, right? So what you've got to ask yourself is that, is the industry earning a fair margin, right? So if you see a company earning anything between 20 to 25% return on equity, right? And we are talking about a world where people are trying to de-risk from China. I had an interesting, I'm just going to make a slight detour. I had an interesting conversation with a purchase manager of an MNC when we were doing a research, and I asked them, how do you think about Indian companies? And to my surprise, the fourth variable he came to was price. The first variable they look at is, can I trust this company's track record on ESG, right? Are they compliant with how they're disposing stuff in the environment? They talked about that, can I trust this company to deliver on time? Can I trust this company that they will not be using child labor, right? So what the world has realized is that the stability of the supply chain is more important than getting a few percentage points off on margin, because you want to work with people whom you trust and you want people to make a fair margin, right? So now all industries will commodify over time, right? I don't know at what pace the margin of a company will deteriorate, but the bet is on the management team that on a core product you will give a little bit of margin off to a customer on pricing. The customer will reward you with more scale. You've got your operational efficiency going, so what pricing you give off, you'll be able to shave off in cost. You'll be working on new products which you will introduce, which will be a slightly higher margin than your old product. So the bet is that the company will make attempts to not commodify. Now, what is in our control? In our control is that you've got to be careful therefore of what price you're paying. You can't assume that growth rates that one is seeing when a company is smaller are growth rates you can extrapolate for very long periods of time. Now, you have to assume that a certain amount of margins will reduce over time. But again, keep in mind in chemicals that typically in the chemical industry, while margins might come down over time, your return on equity might actually climb, reported return on equity, because most chemical companies will depreciate their plants over 8 or 10 years, while the useful life of their plants is much longer, right? So again, I'm saying that you always have to be concerned about what can go wrong in the environment. But one cannot be excessively mathematical, or one has to trust that these are people who've created great businesses and they know how to navigate this, right? So one's got to be watchful, but one can't make a hypothesis that this gross margin will come down to X% over time. I mean, you have to believe that broadly the return on capital profile of the company will get protected over time if they're doing the right things.
I just want to ask one last question on this topic. I want to understand how you evaluate execution capabilities. And here I'm specifically talking about capacity building within the chemical industry. So we constantly hear of chemical companies that are putting up new plants, investing in new products, trying to scale up operations. So while everyone says that they're doing that, how do you decide which ones are actually able to execute on their plans and which ones are not going to be as efficient as others?
It's a great question, Krish, and I'm saying this is an impossible question to answer about how someone's going to behave in future, right? And the best way to look at it is just look at the historical track record, right? It's the same analogy that we would use for a bank, right? That if a bank has been fundamentally conservative over the last 5 years, they've managed their NPAs well, you can take that as an assumption that why would things change, right? The easier way to answer it is that somebody who's not been disciplined, right? Somebody who's trying to grow much too fast, you got to be a bit wary, right? I would never buy into a belief that this person will change. No, it may happen, but typically 8 out of 10 people do not change. 2 out of 10 will change. So you might miss 2 out of 10, but you won't make errors in 8 out of 10. So the answer to that question lies in history. Just look at how a company has behaved in the past. That is your evidence for the future. We don't have to. I think there is this. Bharat Bhai of ASK. I remember he was speaking somewhere and I was listening. He said, "Don't try and leave your footprints in the sands of time. That I will discover this new multi-bagger and I will discover that." There's so much of opportunity in companies that are well discovered. Now we keep our 10% bucket, like I said, right, of things that we will experiment with. But we would never put boatloads of capital into a company that is not executed well in the past and koi sapne dikha raha hai ki now the future is going to be different. We're not going to do that. We just can't judge how people are going to behave. So if you've got something that is tried and tested, that is done really well, right? Now you look at the example of other industries. HDFC Bank is still HDFC Bank. DB's Labs is still DB's Labs. TCS is still TCS, right? So when you try and go down to the path of discovering a new winner, I'm sure if you do, if you spend a lot of time, out of 10 such companies, you will discover 2. But you'll get 5 wrong. and those 5 will clean you out on the 2 that you get very, very right? So if the intention is not to take imprudent risk, to be able to compound capital at a reasonable rate, we believe 90% just back the 50% of our portfolio is clear leaders, what we call, where these guys exist. The 35% in emerging leaders, again, these are companies which have been out there. If you just study the promoter's track record, you will get a good sense of how this guy is going to behave in the future. So I will not try and be Nostradamus and predict who's going to execute better in the future. Your historical track record is, 80% of the answer.
So before I end, I actually want to get a take on something related to your business, which is investment management. How easy or difficult do you find it to be a contrarian in a business where underperformance can be not only very swift, but very public?
Yeah, so we are facing the music a little bit. The last year we're down 10%, the market's up. So I think this is a tough business. I mean, I put on a lot of weight. It is a tough business. I think the critical thing is to have clarity on what you're doing. You can't be playing someone else's game, right? And the important thing to have, I think, a huge, not enough talked about factor of success in our business is the quality of your client base. So I don't think investment firms should grow very quickly. We are very, very selective in how we use distribution, because you don't want anyone walking in to say that, could you manage some money for us? Because people have to not only trust you that, you're not going to be doing any monkey business with their money, but they also actually have to buy into your process, truly understand your process, right? And the challenge in our business is that what is right in 1 year time horizons may actually be a suboptimal decision from a 5-year perspective, right? So you got to choose, right? So it's not easy. The way we are learning, we are evolving, but the way we have tried to deal with it is to be very, very transparent with our clients, with our partners on why are we doing what we are doing, right? And hopefully, that will create more alignment. We will have a partner base that understands what we are doing. We are not going to change, we will learn. You learn from your mistakes, you have to adapt. But what we don't want to change is that the long term is our North Star. I don't want to start playing short term video games to manage performance just because of client anxiety, because I know that is the wrong thing to do long term. So we are happier working with a smaller AUM, smaller base, but doing what we deeply believe in, which is keeping a ruthless focus on the long term and executing to long-term outcomes, which is, and our metric for that is returns over rolling 5 years. So we honestly don't worry about what might happen short term. It's a worry because, I genuinely feel I'm letting people down if they've given us capital and we are underperforming short term. But that's more of an emotional response. I am very confident if I stick to our process and with discipline, we'll have the outcomes that we're looking for in 5 years. So I don't know whether that answers your question.
No, I'm just gonna ask something based on what you said. That while periods of underperformance are undoubtedly painful, do you see the silver lining of such periods that it helps, in some sense, a self-selection of clients? So that only people who really buy into the process that the fund manager is following would actually hang on, and maybe if there is, in some sense, some amount of hot money which maybe in your business is not as much the case as it would be, say, mutual funds, but that kind of hot money actually leaves the fund and therefore you only have the true believers left?
Yeah, actually that's very healthy, because the challenge is that when you are subscale, I think that's a challenge for fund managers who are new. We've been blessed, we've been very lucky that we have not had that problem the last 8.5 years. And, so we have reached a scale where, if we lose some AUM to hot money, it would not bother me. But I'm very empathetic, and I sometimes wonder that when I was a young fund manager who was managing smaller pools of capital, if because of short-term underperformance, clients took their money away, how would I react, right? Now, I'm lucky I did not have that problem when I was a young fund manager. But, I'm 50 years old, I want to live my life a particular way. I will not change the way I want to do things because of the fear that people will withdraw, Now, it's been close to 9 years since we've been running our fund. Our target is about 3% alpha, we are at about 5% plus. So, we have confidence in how we are doing things, and I will not change how we do things just in order to grow the AUM. We want to grow the AUM a particular way. It's a stressful business. You want to travel well. You don't want to just increase stress to maintain your AUM. So, but I have a lot of empathy, and I don't know how I would have responded to your question if I was managing much lower sums of AUM, and I would not know how to respond then, because you need a certain scale in order to keep your shop running. So, but if we have reached a certain scale and we have the trust of a certain amount of families, it would be stupid of me to change what I'm doing just in order to grow the AUM, to follow a strategy that I don't believe in.
Manish, this was a lot of fun. Thanks so much for your time.
Sure, Krish. Most welcome.
The team at Solidarity publishes a letter to partners every quarter. I highly recommend reading those letters, as they offer not only investing wisdom, but also a window into the elation and humility that comes with investing in public markets. I hope you enjoyed this video and learned something new. Don't forget to like, subscribe, and hit the bell icon. Thanks for watching.